welcome back, traders and investors, to the Benzinga Pre-Market Prep Show. We are going to be wrapping up our Monday show with our guest, Martiak. He is a senior wealth strategist over at Premier Wealth First Allied Securities. Mark, welcome to the show. Happy Monday.
Happy Monday, Jared. Thank you for having me, and good morning and to all of the Benzinga loyal following.
Yes, everybody's kind of digging in this morning, and we got a lot of guys that are listening in, looking for some advice. And it seems like we slowly go from talking about equities and then try to get to a more macro basis, and so it seems to drive it. What do you think's going on in the world today? What are we looking at? It seems like total chaos out here.
Yeah, well, I'd like to say that the U.S. economy is a plow horse economy right now rather than a racehorse economy. It's shifting into higher gear, which should help incrementally improve global growth. So the headline risk clearly, right, is everywhere else in the world because of the slowing GDP. Mm-hmm. But I believe that because the U.S. economy is shifting into this higher gear, we're gonna see equity prices grind higher. That's why I call it the plow horse economy. And I believe that the falling oil and commodity prices, while they've stoked kind of global deflation fears, they're putting pressure on energy producers, including the U.S. energy industry. So ultimately, I believe that the falling oil and commodity prices, Jared, are mostly positive for the global economy because lower prices will eventually boost consumer spending. And at the end of the day, I believe falling oil and commodity prices will prove to be reflationary rather than deflationary.
So do we go back to like a manufacturing kind of economy with this shift over into a plow-through economy? I was reading from the Richmond Fed a few weeks ago.
I think you hit it right on the head there.
Yeah.
I agree. Yeah, I think manufacturing. We're in the midst of a renaissance of manufacturing, and it covers various sectors. If you look at the equities sectors and the top performers so far, early as it is in the first quarter here. Industrials, energy is certainly leading. It's up 6%, but many pundits would question whether that's a dead cat bounce. But industrials is right behind it at a positive, almost 1.5% through the first month. So between energy, technology is in second place. Industrials are in third place, but still, that bodes well for those three sectors: energy, technology, industrials versus consumer, which is slightly down. Healthcare, while it's a positive 0.79. Financials are down and utilities are down. So, but I think consumer will start to develop as we get into the second and third quarters of this year.
So if you're seeing a shift into more of a more fundamentally strong base, it sounds like, that kind of seems to be what I'm seeing also. What do you think the central banks are going to do? Specifically the Fed. Is the Fed going to just continue to let the system run as is, untouched, or are they going to try to, do a little intervening here to see if they can put any pressure on the economy without breaking it completely?
I think the intervening is right on, and I think intervening in the sense of obviously ending monetary easing. And they're going to raise rates sometime. I've been suggesting mid-2015. I know you've had other guest colleagues of mine that have suggested it probably won't happen. But central bank divergence is upon us, obviously. The ECB and the Bank of Japan are moving toward even more easing and have embarked on that. So what does that mean for fixed income as an asset class? The short-term bonds should feel the impact of rate increases more than long-term bonds. And as lower rates in Europe and Japan increase demand for long-term U.S. bonds, that will impact the bond sector here because they'll be they'll have more relatively attractive yields, U.S. bonds that is versus sovereign debt in Europe and Japan. So. Expect a stronger dollar because these divergent central bank policies support a stronger dollar with a number of implications, again, including what I just touched on about, with lower oil prices. And those lower oil prices benefit oil importing countries like China, and like India, and like Japan.
So I mean, talking about bonds and looking, we were talking about overseas. What do you think about this whole situation with Greece deciding to, restructure their debt and the discussions of, pushing back against the ECB and potentially it looks like they're almost using their exit from the eurozone as kind of like a hostage negotiation. What do you think that
I,
this is
I
going to do for sentiment for people overseas that are perhaps investing in government bonds or wanting to lend money to sovereign nations in order to fund their debt operations? What do you see any major fallout coming from Greece? It just seems like this is too big of an action to ignore that what Cyprus is doing over there.
Well, QE in Europe is not going to help boost growth. It's just going to stuff the Europeans banks with as many useless excess reserves, like similar to what the U.S. banks hold already. So
Yep.
I don't think there's going to be major fallout. In fact, U.S. in particular, with respect to our exports to Greece, those exports account for less than 1/100% of U.S. GDP.
Oh, really?
So I believe that there won't be a major fallout. I see many in business and finance suggesting that Greece leaves the eurozone by year's end. I'm not so certain that will happen. I can't predict that, but I can suggest that they're gonna have to rework their debt structure, and if not, then they'll depart. But I don't see any major fallout. Instead, investors need to focus on the fundamentals that drive the local economies in Europe, around the world, certainly in the U.S., which haven't changed. These fundamentals. Monetary policy remains too loose, if you will, especially in light of the ECB's recent quantitative easing program that they've launched. Tax rates are not going up, regardless of what President Obama suggests here in the U.S. Having come out of his State of the Union address. I don't see that happening with the Republicans controlling the House and Senate, and entrepreneurs are still innovating throughout the world, but nowhere more so than in the U.S.
So what happens with the U.S. government then? If I can get into that, if the Fed does maintain low rates, do we continue to fund government on the same levels that we have been, or if they raise rates, is this going to cause a lot of problems for the U.S. government's ability to actually pay the interest on its debt? I've been looking at interest expense, and it seems like if the Fed were to raise rates, it would cause some serious problems for the U.S. as far as paying its interest expense and paying off its debt. So it almost seems like the Fed's kind of painted itself into a new normal corner where they're stuck doing what they're doing unless they can fabricate some other sort of synthetic way to manufacture growth in the market.
I agree with you, Jared. Yeah, I don't see that happening. I think they have to kind of maintain the course with regards to this monetary policy, and you're right. Maybe they don't end perhaps monetary easing sooner rather than later. But they are in a corner. But remember, they print money. They print money, so they eventually know what they're doing. But as I said just a few moments ago, they have useless excess reserves. They're not probably paying. You may have looked at it more closely than I have, but they're not paying high interest on that. So I don't see that being a major issue. Obviously, this aggressive stimulus from our central bank as well as the ECB and Bank of Japan have thrown a lot of trends into reverse. So and certainly the dollar sits near its highest level in approximately 11 years against any major currencies, a basket or individually. So more easing and more dollar strength should be expected. And anyway, with this new bond buying program that was launched last month, the euro is sinking to within a striking distance of closeness of parity with the dollar for the first time in about 11 years.
So what ends up happening with U.S. stocks? I mean, if we want to look at things like retails, automotives, banking, what sector do you think is going to end up performing strong over the next, few months here, if not, throughout 2015? Do you have any personal favorite sectors or stocks in general that you like?
Yeah, I do. Consumption, and by that I mean the consumer services, consumer discretionary sectors, and in the subsector of that would be automobile. the automobile industry. And it bodes well for for your territory near Benzinga's corporate offices, if I'm not mistaken. So auto sales increased at a rate of 0.5% annually in Q4, while real inflation-adjusted retail sales outside the auto sector were only up a tepid 1.8%. So, and services make up, as you know, 2/3 of personal consumption here in the U.S. 70% of our GDP is attributed to consumer spending. So I see that personal consumption of goods and services combined growing. They grew at an annual 3.8% in Q4, which contributes about a little over 2.5%, 2.5 points to the real GDP growth rate. Right, so I like automotive. I like industrials, automotive and consumer overall. I like industrials, as I mentioned at the top of the interview. I like business investment, CapEx spending, which bodes well for manufacturing. You mentioned it earlier, and technology. As far as home building goes, a 9% annualized gain in home building in Q4 is going to add about 0.3 points to real GDP, so which is about 9 times the home building share of GDP, which is 3% equal to like 0.3. So those are sectors that I really like. I like biotech. I've been saying it a lot in the last few quarters. We're in the golden era of biotech with what's going on. So biotech is important, and I just see, because of this first quarter with the weather conditions, we saw something like this last year at this time, if you recall. Many of your listeners would agree. Real GDP dropped in Q1 of last year, and some analysts were predicting another recession. But by contrast, we said the drop was due to unusually harsh winter weather, and the economy would rebound very quickly, and that it did. And the same thing can be almost like a mirror repeat this quarter with many areas of the country, many regions of the country dealing with bad weather. I think we'll climb out of that, and you'll see GDP bump up nicely. So overweight, I like equities, U.S. equities, obviously, in terms of sectors. Japanese equities, I think they're overweight. In terms of fixed income, I really like munis, because generally speaking, you get the triple tax exempt, state, local, and city. If you're in a city, I like mortgage-backed securities, and I like high-yield bonds. But high-yield bonds, you have to be very careful with, corporates as well as munis, as we're facing a rising interest rate environment. Underweight, bonds in general, defensive stocks, and treasuries.
So with the 3 sectors you pointed out that you liked in the overweight U.S. equities area, can I get a few examples from you, perhaps, of what you do like in housing, like a specific stock or ETF? Same with automotive and biotech. I'm just getting a couple emails, and some guys actually they really like what you have to say. They just want to see if you have any specifics, perhaps, that you would be willing to mention.
Because of FINRA, I can't. But here's what I would offer to the listeners who would like to email me. They can email me at mmartiak at PFA Wealth. That's Premier Financial Advisor. mmartiak at pfawealth.com, and I can talk about individuals with some caution. With some very important caution. Because of regulations, it's hard for me to venture beyond sector recommendations and other than talking about performance or outperformance or market weight or underperformance. But if there's some way I can offer that to your listeners, I'd be happy to talk about that rather than to broadcast my picks in each of the sectors. I hope that, I know that's putting off, but I have to abide by that.
Oh, it's understandable. I mean, you got to eat. You got to make sure you keep your job. I totally get it. I know FINRA can be pretty tough with that stuff. To completely understand. I appreciate you at least explaining it and clearing it up and making yourself available to the listeners. I mean, that's fantastic. So I'm thankful that you did that. And we'll get an email out to the guys if anybody wants to do that. If we can throw it in the chat, that'd be amazing.
Please. I know how loyal and how focused your listeners are, and that's what I enjoy the most. So I want to help in any way that I possibly can.
Yeah, it's a hungry group, so thank you. Yeah, they're always looking for something, especially now in 2015 with a no Fed rate hike and overweight U.S. equities coming out of Mark here. It looks like 2015 is hopefully going to be a strong year for traders, and we'll see what happens here. So, out of the three, then, if I can just narrow down the out of the housing, automotive, and biotech, which one do you like the most? I mean, you said automotive, right? And then what is it? Automotive, housing, and then biotech. That's the order for you. So we're thinking like Tesla, KB Homes, and somebody over in the biotech region, perhaps.
Yeah, that's right. You, auto should be strong. I see that because obviously more jobs growth, right, contributes to higher consumer confidence, contributes to more spending. In fact, in the last year or so, consumer debt has risen by almost 9%. Okay, so what does that tell you? That tells you that as we come out of this, very difficult recession, consumers, as they go back to work, feel better about what they're doing and are willing to spend more money. So I like consumer a lot, and and discretionary as well. On the high end, not just the services, and that includes the staples as well. I like the business investment, automotive across the board. Take a good look at that sector because you'll see the spending impacted there. And not just for new cars, but for pre-owned vehicles as well. And proceed carefully, cautiously with home building, the home builders in particular. Biotech, obviously, there's so many new developments and technologies right now, and you see you see fusion of technology and pharmaceutical, big pharmaceutical. There's a lot going on in that sector. You don't have to look far to know the names. There are very established names, but then there are names that are on the horizon that are doing some wonderful things with their vaccines and creating something new and exciting that will help cure everything from liver ailments go throughout the rest of your body, cholesterol, and issues that we face, as in an aging American population.
All right, well, Mark, thank you. I really appreciate your insight, buddy, and I understand you can't get down to some specifics, but thank you for coming on. Ladies and gentlemen, we have been speaking with Mark Martiak. He is a senior wealth strategist over at Premier Wealth First Allied Securities. Mark, thanks for coming on, sharing your ideas, and have a great week, and I hope you take care until we talk to you again.
Jared, it's always a pleasure, and I'm delighted to be a guest. I look forward to doing it real soon. Thank you again.
Excellent. Cheers, sir. Thank you.